Ladies and gentlemen, good afternoon. I'd want to call the House in order so that we can start. Hey. Time is not on our side. This session was supposed to start at 11:45. We are almost 1 hour late. So let's get started. This is the Bridging the Equity Gap session. It's a thematic session, Bridging the Equity Gap, Innovative Solutions for Scaling Decentralized Renewable Energy. And welcome to the session. My name is Beatrice Muthoni. I'm a Principal Renewable Energy Specialist with AfDB, SEFA group. SEFA and the AfDB, I think most of you know AfDB, but SEFA is a multi-donor trust fund managed by the AfDB, provides catalytic finance instruments to unlock private sector funding in the renewable energy space, the broad renewable energy space. At SEFA, we have three broad thematic areas. We have the green base load that deals mainly with IPPs, generation, transmission, and largely distribution. We have green mini grids, which is why we're here. And then we have energy efficiency that broadly deals with clean cooking, electric mobility, and everything in between. So I will quickly set the background for this particular session. But I think if you attended the morning session, it was very clear that one of the things that are missing in the sector is equity. Funding is one of the biggest challenges we have in the sector, but specifically, equity is a big component of that. And without equity, most of the companies are not able to scale up because you need equity to mobilize more debt and the rest of the financing. So a few quick facts, also cognizant of time. Is that in 2022, the Africa Energy Outlook estimated that achieving universal access to affordable electricity by 2030 will require connecting 90 million people annually. As we had in the morning session, population growth is almost going up faster than we are electrifying the population. So we will need to electrify 90 million annually. If you think about it, if you sit down and think about that, it's actually a lot of connections. A lot translates to roughly around 22 million connections. So if you're developers in the house, if you're investors in the house, you can tell by the number of connections you report at the end of the year and how long it will take us to achieve 22 million connections. I don't know what's happened to the screen, but I'll keep going. So for this to happen, we need about $25 billion per year, basically, to get to the 90 million, to the energy access population. So, and it's very, very clear that one of the challenges is the access to finance, and that remains a challenge throughout the sectors. Just recently, I think towards the end of last year, Gogla released a report, and in that report, there was a 43% investment drop in 2023 compared to the previous year. So in the DRE sector. So we've seen a reduction in financing in 2023 compared to 2022. What is more detrimental is that the equity investments reduced by 70%. So we really are in critical need of equity investors in the room. So what has this done to the market? We have seen a lot of consolidation. Small private players are actually, most of them, folding up, getting absorbed by the big players. And I don't know if this is catalytic to the growth of the sector. And we'll discuss about this more today by the panelists, but there's shrinkage of the number of developers in the sector because there's not enough equity, and most small developers need grant and equity to grow. So the main purpose for today's session is to highlight some of the initiatives that we have in the sector, bringing in equity to the space, and specifically for SEFA to address the critical shortage of equity. SEFA continues to explore catalytic equity type investment opportunities. Some of these opportunities that you have invested, it's unfortunate the screen is not working. Some of these opportunities that you invested in the recent past include Persistent Climate Fund, Venture Fund, which is supporting very, very early stage developers in the space. And then we have Kawi Safi Fund 2, which supports between early stage and growth stage companies. We have Amharith. I won't talk much about Amharith because we have Derek, who is from Amharith, and he'll give us a bit more details about their fund. But one of the critical things Amharith has done is that they have managed to unlock local pension fund. And that is one of the critical components of financing in this space, because one of the biggest challenges you see in the space is FX risk. And if you are able to unlock local currency financing within the countries that you're in operations, that's a big win for the sector. We've also, as SEFA, funded part of the Power Gen Solar Mini Grid Expansion Platform and the Cross-Boundary Energy Access Platform, which aggregates as portfolios in the sector. And the last initiative that I'll talk about, and I think most of us have had it in the morning, we're part AfDB and the World Bank started this Mission 300, and as we all know that 40% of these connections will be done largely through the DRS sector. So as part of Mission 300, there's like a big initiative that the World Bank team and the IFC team has talked about this morning, and it's called the DRE Equity Platform, Project Zafiri. It's a blended finance platform that will leverage, amongst others, local finance sectors, and we'll have like first loss capital plus commercial capital. So it will be a large equity platform that will hopefully provide new momentum to the in the space basically, and bring in more equity to the space. So without much ado, I'm going to invite my panelists, a group of really amazing people who are doing great in the DRE space, and specifically in the equity space. I'll start with Derek Chime, the Chief Investment Officer of Amharith. Karibu. And then we'll have Doris Muthami, Business Development Manager for InfraCo Africa. And then we'll have Idris TAYEBI, Chief Executive Officer for NEOT OFFGRID Africa, famously now known as NOAA. Karibu. And lastly, but not least, Ieva, Policy and Partnership Director for Camco. These might be familiar companies to you guys, or maybe not, but the main purpose for this session is basically to bring out the innovative solutions that we are currently working on, all these people are working on, and I'm sure a lot of us, into the space to try and bring forth more equity into the DRE space. So I will sit down so that we can start the questions. We don't have a lot of time, so we'll hopefully finish by 1:30, 1:45. Bear with us a little bit. We are coming in between yourselves and lunch, so hopefully you've had a bit of coffee. And yeah, please enjoy the session. I don't have a microphone on my desk, so I'll start. No, it's okay. So we will go straight into the questions, and I will start with Idris. Idris, I think we have had, since yesterday actually, I attended the European DFI session, and one of the biggest challenges that were mentioned over and over again is the lack of equity. Maybe from your own perspective, and I know your company has been fundraising, has been in this space for some time. What are some of the drivers behind the lack of equity funding, and how can we overcome this?
Thank you, Beatrice. So I think that on our side, we identified some key drivers that are still blocking a little bit the the opportunity of private capital to really flow into the sector. I think that you have the typical needs from an equity investor that are still missing in the market. So
They can't hear you.
sorry, can you hear me now? Thank you. Can you hear me now? It's okay? Okay, perfect. So, no?
No? No. No.
It's working, yeah? Okay, perfect. Sorry. So I think that we can summarize maybe this, the driver behind the lack of equity in the market in three different categories. When you look at how equity investors behave in normal markets, I would say, there is some very basic concepts that are still somehow lacking, I think, for the class of assets that we jointly want to develop. First of all, I think that the risk perception of the sector from equity investor is still very high. And this is coming from what I call the first phase of the sector, which was basically the mini-grids that have been deployed over the last 5 to 10 years, roughly, where you have very few success stories in terms of return and capacity of the projects to repay their investors when you have private investors. In our case, we are one of the few investors in the market that is deploying private capital. We have two private investors, which are Meridiam and EDF. And so far, the risk profile of the assets is not up to the return that we actually get. So I think it's very important to recall that, and it's very basic finance economics, I think. One key parameter that we see that is still blocking some private investors to step in the market is actually the absence of liquidity of these assets. So we don't see a lot of secondary transactions. And when you are a PE fund and you want actually to take an investment decision, part of your investment decision is obviously the exit strategy. So today we have very few examples in the market showing that these exits are possible in good conditions. And then, well, the other and the last one that I can comment on is the profitability itself and the productivity of capital, meaning that you deploy a lot of money and we still see that the assets that are deployed are not as productive as they should be because of the way the first projects have been designed, and we think that actually there are ways to solve that through a better sizing, better design of the projects themselves. So that's basically my key taking point on these barriers.
Thank you very much. I hope you can hear me.
Yeah.
Okay. Thanks, Idris. I think what you have mentioned is there are few success stories. I think some developers would disagree with that, but I hear you. Plus, profitability in the sector is also not really. It's not in the teens and 20% of it. So we understand that. Doris, maybe to come to you in terms of risk versus return, as equity investors are mainly looking for return for their investments, and what does it take to better align the needs of DRE projects and businesses in terms of equity finance with the risk, appetite, and return? And I think Idris has mentioned that a bit, and return expectations for the investors. And maybe as you answer that question, you can start by maybe introducing what InfraCo Africa does, and then you can delve into the question.
Yeah, thank you, Beatrice, and good afternoon, everyone. So my name is Doris Muthami, Business Development Manager at Private Infrastructure Development Group. That's PAGE on the development arm called InfraCo Africa. So PAGE, we are funded by a consortium of several governments, but mainly by the UK government through FCDO. And we have a couple of solutions under our umbrella as we try to support projects through different life cycles. It's quite a bit, but I'll try to be brief on each. So we have the technical assistance facility that provides the concessional equity, debt, viability gap funding, in response to some of the challenges we are seeing in the sector, to try and bridge the gap between the risk and what returns can be realistically achieved. Then we have our debt component, which is provided by the Emerging Africa Infrastructure Fund, covering Asia and Africa. So basically, we know commercial debt is not readily available for this sector in the right maturity or with the right risk profile. So that's what that looks to address. Then we have the liquidity support and guarantee solutions through GuarantCo and our credit enhancement facilities. Of course, you can always reach out to me separately to understand that. But the reason why I'm in this panel is InfraCo Africa, which does the early stage development of the projects. We do equity or equity-like structures for renewable energy in IPPs, mini-grids, CNI, and solar home systems within Sub-Saharan Africa and Asia. So to address the question and what is needed to bridge that gap, of course, for an equity investor, returns is what is key to incentivize me to take the risk. But reality is maybe due to affordability or regulatory concerns, that is not able to be achieved. So what I think is required is data access. As we have said, this is no longer a new sector. Technology has evolved. Some companies have deployed. So there's enough information on the different geographies, on the risk expectation and challenges. So if we are able to share this information more transparently, then the equity investors are able to realistically then price the risk or find suitable mitigations to then adjust the returns. So I'm appreciative of institutions like AMDA and AfDB for the white papers that they keep publishing on the sector to create this kind of awareness and try to bridge that gap. The other thing I think is the regulatory element of things. In some markets, like in Uganda, Nigeria, this has evolved, and the regulatory for DRE space is firmed up, which reduces the lead time and the costs that we incur as equity developers to try and get these projects financed. And so with clarity on that, that reduces the risk element, and of course the return expectation is then able to be adjusted accordingly. The other one is a blended finance approach, which is what PIDGE is seeking to do through our various solutions. It is the reality that concessional capital will still be needed to be able to bridge the gap between impact, affordability, and the costs of deploying these DRE solutions. So if more partners can look into providing this concessional capital in a meaningful approach, because sometimes it's provided with so much hurdles that it does not achieve the purpose it was supposed to achieve in terms of minimizing the risks to the equity investors. Something that is also coming up is aggregation in the sector. So the ticket sizes tend to be very small vis-a-vis the costs that we would incur to be able to invest in these projects. So the consolidation or platform approach is allowing the equity investors to somehow reduce the risk perceptive, and therefore the return is able to be reflective of that risk. Last but not least, which was mentioned by Idris, is the absence of exit routes. So if we can find ways to strengthen the local capital markets and capital capacity building to local currency providers like pension funds who are sitting on a lot of that kind of money, then I think we will be able to unlock more equity and align the returns expectation. Thank you, Beatrice.
Thank you very much, Doris. I think we have seen a lot of development in the space. We've seen very innovative structures across the space. And recently, there's a lot more development in the space. I think if I can mention one or two, there's off the balance sheet financing of receivables that is slowly taking traction. And I think at the Gogla conference, that was really highlighted as one of the solutions that could really help in the space, because a lot, especially in the solar home systems, a lot of the companies are struggling to finance their working capital, and that's the off-balance sheet financing of receivables will come and really unlock that and reduce the equity burden to the developers, to the end developers. So maybe looking at Derek, and maybe after that, Ieva, you introduce yourselves, and then maybe you tell us what are the latest developments, because I know your companies are doing great things in the sector. What are the latest developments and innovations in the blended finance structures and catalytic instruments are out there aiming to unlock more equity in the DRE sector?
Thank you very much. So I work with ARM Harrit, Infrastructure Investments Limited, an private equity investor in infrastructure generally. And we've been investing in the DRE space over the last 4 years, primarily in Nigeria. We are in the process of completing the raise of our successor fund, which would look to do more DRE projects beyond Nigeria as well. Now, I think just drawing from what you've heard earlier on, the perceived risk is real. It does not mean that it is necessarily true or insurmountable. What we've realized is, just like any other private equity fund, we are beholden to investors to make good investments and also deliver returns for those investments. And the key question has always been, can we make good returns from these type of investments in the DRE sector? One thing that is very clear is that DRE is not like your conventional infrastructure type projects. You can't execute it in the same way. The risks might be the same, but the tools available to deal with those risks are totally different. And I think one of the big mistakes that we tend to see is a lot of people try to apply the conventional approach to infrastructure investing to DRE, and tendency is that it won't work. And if it does work in the short term, in the long run, it might not work, or most likely would not work. What we've tried to do is approach this from two perspectives. One, from the fund level, which is getting that encouragement or giving that encouragement to investors to be able to come to the party, particularly commercial investors, to be able to come to the party and also partake in the equity risk with regards to these projects. And then on the second level is at the project level, how we also try to mobilize participation at the local level. I think one of the things that at the fund level, we've leveraged the use of blended finance, we've leveraged the use of concessional finance. Our current fund, our successor fund raise currently is being backed by SEFA to deliver on these type of projects. We've also been able to bring in other types of junior type equity into the fund structure to make the commercial case for the senior equity providers more palatable. At the project level, most of these projects at this stage, and given the early nature of this particular segment or sector, most of these projects are quite expensive from a capex point of view, and you can't do it with straight conventional equity. So what we've tried to do is we've also at that same level brought in the use of grants to mitigate and some of the commercial risks that the commercial investors would be facing at the project level. And then I think one very powerful tool, and this we haven't done, but we intend to do, is something that was mentioned by Idris earlier on around exits. As we try to exit these projects, you're more or less creating a self-reinforcing theory around the prospects of this infrastructure category. And one of the ways that we are trying to do that or actualize that is by actually stabilizing these businesses and offloading, looking to offload these businesses to investors that would seek stable returns and who are local investors, most importantly. I think it's very critical that local capital plays a role here, and a very significant role. There is the FX risk component we talked about. These businesses are very small. They cannot absorb those kind of FS risks in the way that your normal conventional infrastructure projects could. And also there aren't sufficient, you cannot mitigate those risks or those FS risks the way you would in your normal infrastructure project. So what you really need, or the best way to do this, is to be able to substitute that foreign capital or dollar capital for local capital. And on the, just on the final bit, and just drawing on what Doris had mentioned earlier on, in terms of the approach, you can't approach DRE as, again, like I mentioned earlier, you can't approach DRE the way you would approach your normal infrastructure investments. These are relatively small check size businesses. At the end of the day, they are all individual projects on their own, require significant amount of work. But if you're going to be deploying very little capital for the same amount of work, it might become untenable. So you have to create a structure, like Doris mentioned, platform that provides localized solutions and management solutions for those projects that come under that platform. Thank you.
I want to follow on two things. I think you mentioned exits. Have you managed to exit any of these small investments?
We haven't, and we do not intend to exit them individually as projects because, again, they are still, even if you're generating all kinds of returns, they're still very small. But what we're looking to do is to exit them as a platform and as a portfolio. And it's not just a portfolio that aggregates different projects. There is also a service within that portfolio that is able to enhance the profitability at a portfolio level of those projects.
Thank you, Derek. Maybe over to you, Ieva, on the innovative solutions that you're offering to the space.
Thank you. Maybe first just a quick word about Camco and what we've done in the past and what we're doing today. So Camco is a climate and impact fund manager. We're probably best known in the space for having managed a facility called REP, the Renewable Energy Performance Platform. We've managed REP since around 2016 and supported, I believe, around 10 or 11 mini-grid developers on the continent. REP was able to offer a very diverse range of financing instruments, starting from equity, going all the way to different types of debt and everything in between, including some hybrid instruments such as convertible notes, which we've used also to support some of the early stage pipeline development on the continent. We now, you may have seen announcements that we have closed on a new fund that's called REP2. REP2 will be primarily a debt fund. It's a blended finance facility, which perhaps would raise a question of why I'm sitting on this panel, apart from our experience in the past. But I wanted to speak a little bit about some of the other instruments that we are planning to offer in this space. And one of them is called the PREC aggregation facility. I think there's been an increased interest recently in all types of RECs. RECs stands for Renewable Energy Certificate. It's a type of environmental attribute that monetizes 1 megawatt hour of generation produced from renewable energy sources. And in our case, we are working with what's called PEACE RECs, or PRECs, which has an additional impact label and indicates that the project is producing in a country that is considered to be a fragile market. It's a concept that was developed by an NGO in the US called the Energy Peace Partners, which is the only exclusive labeling authority for PRECs. PRECs have been around. There have been sales made of PRECs, most notably perhaps with Nuru, that is a big proponent. Nuru is a developer of isolated grids, operating them at the moment in Goma in DRC and developing new projects still in this extremely challenging context there at the time. They have worked with EPP on the sales of PRECs from their existing projects. So at the moment, PRECs are being sold. They're sold from projects that are already generating. What we are trying to achieve with EPP, and Camco has been working in partnership with EPP now for about 2 or 3 years, we are getting to the final stages of it. We're in late stage due diligence for this pilot facility. It's called a PREC aggregation facility. So the problem that we're trying to solve, or the solution that we're aiming to offer, is to take the current PREC offering a bit further and be able to offer that on an aggregated scale. So we're raising into a small, at the moment, pilot facility, which will allow us to prepay some of the PREC revenues for developers, and also sign offtake contracts for the remaining estimated PREC sales in the future through long-term contracts of 7 to 10 years. So we're aiming to be able to provide financing that could account for between 5 to 10% of the total capex of the project, depending on the size and technology. Yeah, for project developers, we hope that PAF, as we call it, so PREC aggregation facility, could be quite an innovative additional source of financing to be able to recycle some of their perhaps developer equity. The funding would be offered at the moment, we're looking to mostly do that at COD, but with commitments being signed early on so they can be used in their fundraising processes, and experiences of developers working with EPP to date indicate that the PRECs and estimated PREC sales can actually form an important part of their conversation with their other funding partners. For developers, PAF will also offer a much easier and streamlined way of selling PRECs on a long-term basis. And most importantly, we hope to really try to catalyze the market for the buyer side of the equation. PAF will allow buyers to buy on a much larger scale across multiple markets, both spot and forward-looking contracts. So again, for corporate buyers, it should be a much more attractive alternative. PAF has been in design and fundraise for a while now, but as I said, we're coming to the final stages, and hopefully by the end of this year, we should have an operational facility.
Thank you, Ieva. Just maybe a follow-on question for me. How can developers, once the PREC facility is up and running, how can developers access this facility?
Well, we encourage everyone to get in touch now. We haven't put out a lot of communications yet in terms of the eligibility. So the key starting point is whether your projects are in an eligible market, and then some additional eligibility criteria attached to that. But please feel free to get in touch either with the Camco or with EPP directly. Happy to share the contacts as part of this conference. We have already a pipeline for PAF that we are now refining and expanding. So, as we're getting close to reaching financial close, we're very much interested to speak to everyone already now and position for deploying as soon as possible after we reach the close on operations.
Great. Thanks, Ieva. Going back to you, Idris, and maybe take this opportunity to introduce Noah. And then the same question will apply to you, Derek, because I know both of you are in the fundraising process. What are the recent equity fund initiatives in the DRE space have you seen, and what are your experiences fundraising, looking for equity in the space?
All right, so first of all, let me introduce very quickly Noah. So Noah is a platform that is dedicated actually to deploy and manage DRE projects, especially mini-grids. So that's where we are really focusing now. We currently have 78 mini-grids in operations, out of which 31 are in Uganda. We are in Benin, Sierra Leone, and we have one large asset in Nigeria that has been operating for 7 years already. I think that to go to your question on the fundraising process and the way the market is, the equity market is actually looking at the sector. As I said in my introduction, there is a risk perception that is very high in the market when we try to talk with conventional commercial investors. The reality is that when you start showing the numbers and the trends that you are able to build through data, there are some signals showing that actually there is an evolution in the market, especially on the optimization of the assets themselves, and the way the technology is evolving as well. So for example, when you look at the market 7 years ago, it was very hard to deploy a mini-grid based 100% of renewables. Today, we are looking at the alternatives between putting gensets or expanding our battery facilities. Sometimes the answer is put batteries. So that's very important because actually the cost per connection decreased in a very important way over the last 5 years, I would say. through technology and through the experience that has been built in the sector. So the way we try to attract investors in our platform, because we are an asset management platform, is to show that through data collection and the use of the data that we are doing through optimization of the assets, contract management, all of these kind of things, we can show that the next generation of mini-grids can start to look like a more mature class of assets, and we believe that actually this can start to be attractive for a new class of investors. And I'm happy to see that you have pension funds already in Nigeria that are looking at this class of assets. It's been a very long process, and the reality is that you still need to blend the capital of your platform, especially because when you deploy a portfolio in a new country, for example, you're starting without data, we can say that the first 3 to 5 years of operations are extremely risky. So you need to have the instruments that can present a buffer for conventional investors to absorb that risk. Once you have passed that period of time, which is extremely risky, you can be more attractive for commercial investors, and the long-term play is to bring back the infrastructure investors that has low cost of capital, that can actually recover the money without exit, so through self-liquidation of the assets. So you're paying a yield that allows actually the investors to repay themselves without having any exit strategy. But we are not there yet. So the need for PE investment in the sector is critical today, but it cannot happen without a blend between DFIs, donor money, like the initiatives that SEFA is starting to deploy in the market. So, I mean, just to conclude very quickly on the fundraising process, convincing everyone that actually we have a business case with a profit and a controlled risk is depending on the way you are managing the assets, and you are actually able to prove by data that this thing is working.
Thank you very much. Maybe just a rider. Initially, Derek said that DRE sector, the way we invest in DRE right now, should not be looked at as infrastructures, like the larger infrastructure. But eventually, what I hear you say is that eventually these assets these are long-term assets, really, similar to lines that you build, transmission lines. So these are long-term assets. So eventually, we'll probably need to look at them as infrastructure assets and have financing mechanisms that are very similar to infrastructure assets. What do you say about that?
So actually, it's, we are not inventing anything. When you look at the history of the renewable market, you had a phase 20 years ago where you had mostly VC and PE stepping in the market. And after that first phase that lasted like 10 years, you had infrastructure investors that started to step in like around 2010 and so on. I believe that actually we have more or less the same history to build in the mini-grid sector. And my opinion is that it's, on the long term, it's an infrastructure play. But we are not there yet.
All right, over to you, Derek. Just your experience with fundraising and what other initiatives you're seeing in the market.
Thank you. So I think it's been evolving, and the experience has been positive, or moving in the positive direction. When we started in the current fund, the DRE platform that we have is 100% equity funded. And that's because there was just no appetite on the debt side to apply leverage at that point in time, especially local debt capital. Today, that perception is changing gradually, and so I'm speaking at the project level. That perception is changing gradually. There's more adoption or more recognition of the importance of this asset class in bridging the energy access deficit that we have. I think we're still at the stage where we have to still blend capital. And historically, right from the onset when we started or when we raised our first fund 10 years ago, we've always tried to unlock local pension capital to participate in private equity. what we are seeing now is that participation has increased, and we are targeting to raise almost 4-5 times what we raised in the first fund from local pension funds. And this is only possible due to the catalytic financing or funding that we've gotten at the fund level from the likes of AfDB SEFA that is able to encourage that participation in this sector. So it's been very positive. I also do agree very much with Idris that irrespective of where we are right now, in the long run, this will stand on its own. Because if you look at what is happening with regards to CapEx and pricing, you realize that with increased adoption over the passage of time, CapEx has actually been dropping with regards to executing on these type of projects. And you continue to see that to a point where you might not necessarily need blended finance to execute on DRE projects.
A follow-on, and Ieva has a question for you as well. It's critical for us to unlock the local capital markets because, as we all say, is the FX risk is top 3 risks in the sector. How did you convert the Nigerian pension fund, I believe, to believe in this space? Because I think, for instance, in Kenya, we've really been doing a lot of knocking on the doors of those pension funds, but they are either mandated not to invest in such asset classes, or they just don't know about this. How did you convince the pension funds to invest in it?
And correct me if I'm wrong, but I think pension funds are generally the same all over the world. They want returns, and they want those returns to be stable. Sorry? Oh, okay. The pension funds all over the world are generally the same. They want returns, and they want those returns to be stable and predictable over time. I think one of the two big convincing factors. One, there is a track record that we brought to the table of having done it and doing it successfully. Two, the catalytic capital, which is having someone else stepping inside and more or less taking the hits, if there is a hit, before them. A combination of those two factors actually encouraged it. I think on the currency bits, it's pretty much straightforward, given that it's just matching currencies. So definitely open to it. But the first 2 points are really what took them over the line.
I think, no, can I? Yeah. Question for both of you. I mean, it's great to hear about some of your positive experience, but we talked in private a little bit about blending, and you've mentioned blending a couple of times now. What do you think, is most needed right now? Like, should we be talking more about blending at the facility level or blending at the deal level, and what can be more transformational? I think I'm looking, considering that there are like 3 funds either in development or coming up that are supposed to be really transformational. Zafiri, the one by Africa 50, the one by, what's the third one? Light Rock. And knowing the experiences of how, sometimes trying to match different types of investors at the fund level with their very different risk perceptions and, profiles can be really quite tough. And we need something to move fast, to be really catalytic. What's the best approach, do you think? Should we focus more attention at blending is it both, or, what's your sort of thoughts on that one?
Yeah, this is a very good question, and it's one we are still unlocking. So what we've seen is we've been talking about DRE, but DRE means different things to different types of investors, and that is where you get choked out, where you carry either a generalist approach for DRE, or you carry a specific siloed approach and you're applying it to multiple types of investors. You wouldn't get that level of adoption. The way we look at it is that you have to create a flexible proposition that kind of tries to touch as much of the synonymous touch points as you could for the different investor classes. You can't hit everyone because imagine speaking to two different types of investors, and one is solely interested on connections and the other is not interested in connections but very interested in maximizing revenue. That's two different DRE asset classes, basically, and you can't have both of them coming in the same fund. So for us, even the way we develop, or we are looking to, and this is one of the learnings we've had from the previous fund, is yes, it was a platform. We are still going to do the platform, but how do we, in creating that platform, we need to create an embedded flexibility to be able to accommodate as much appetite as possible in it.
Thank you. So just to go with what Derek just said, I think that flexibility of capital is really key in that story. And what we experienced, for example, in our first phase, and what we don't want to do anymore is actually to try to structure a funding solution at the project level, because we are talking about still small tickets, and the assets actually requires reinvestment, and they need actually a continuous attention and potentially additional capital exposure over the lifetime, which means that the nature of these assets actually creates a lot of friction. When you start looking at optimizing the structure on a per project basis, you destroy a lot of value. So basically what we believe that needs to be done is to have a clear mandate at the platform level or at the fund level to make sure that actually the capital can be deployed on a very efficient way. And efficiency goes through the size, meaning that once you have a clear solution to fast track the deployment of your capital, that has to happen at the top core level, I would say, then you're good to go, and to go quicker than what has been done in the past. I think that we jointly, all of us spent a lot of time during the first transactions structuring debt, spending money on debt structuring, doing the due diligence that are bankable at the project level, and at the end of the day, a lot of value has been destroyed during that phase, and that's something that can be improved through bringing the right type of capital at the top, either at the fund or the platform.
Indeed. I think the right kind of capital at the right level is key. Doris, moving over to you. What catalytic instrument and capacity building support are still needed to unlock increased patient equity in the DRE space? And here I want to emphasize the word patient, because 5 years is not patient. I think patient, we need to define patient very carefully here, because I think for me, patient means 10 years, 15 years, 20 years, because this is infrastructure that will last a lifetime. So what do we need to unlock this patient capital?
Thanks, Beatrice. So what we're seeing is if we can find a way to reduce the element of risk perception, then the equity will not be in a rush to exit before things go bust. So I think the presence, as has been mentioned by the previous panelists, of solutions that are willing to take that first loss kind of risk, then that allows the risk appetite and patience of the equity to be there. I think we need to also unlock more on the guarantee side of things. So whether it's a political risk guarantee solution, insurance in the market for these products, and so things that, or revenue risk side of things, anything that can show the equity investor that there's some element that can backstop their losses should things go haywire, then I think that increases the risk appetite and patience element of the equity available. The other thing is, and has been a challenge, is yes, technology has evolved, but there is also a risk that some of the technology that's being transferred is not locally contextualized, so it is failing, and so some of the assumptions that you had made on terms of capex replacements, you ended up having to do them earlier. So I think there is more research and capacity building needed in terms of upskilling technicians on the ground to be able to maintain these assets. in terms of tweaking the assets to be able to be adapted to the local market, and some of the challenges in terms of lightning or that then the assets are able to serve long term as perceived. There's also an element of capacity building in terms of business models that are being applied. At the end of the day, the challenge in the DRE sectors, especially things like mini grids, is the unpredictability of the revenues, that to be able to anchor my patient capital. So if there's a way to continue innovating around that, or finding solutions that can guarantee that revenue in terms of demand, in terms of yes, I think demand and predictability of that revenue, then that increases the appetite and the patience for that capital. And lastly, there's the carbon markets, green bond markets that then come to also offset some of the risks in equity. Then I think that also will be useful in greater, would be needed in greater quantum to be able to allow for that unlocking of the equity in patient. But I think that's the beauty of people like AfDB, SEFA, or InfraCos, based on the funding that we have. Then, unlike maybe some other limited funds, we do not need to exit within, say, 5 years. So we are able to be in the projects for a longer time post-COD until we can catalyze that additional private sector capital. So, I think in summary, that's what is needed. Yeah, thanks.
Thank you, Doris. We have, I think, a bit more, few minutes to ask just one question to each of the panelists. Maybe to you, Idris. What instruments do you think are required in the market to unlock this patient capital? And maybe just a step forward, ahead as well, how scalable the solutions that we are talking about? We need them at scale. For us to actually move the needle at all, we need scale. So how scalable are these solutions that we are talking about, and what do we need to just have a mass movement in the space?
So, well, that's a tricky one actually, because if you want to fast track the deployment of equity money in the sector, actually, you need someone to take the risks for the investors. So typically, I'm going back to the first loss mechanism, which is for us really critical to attract a more commercial type of investors. That's where the money is actually. But the level of risk that is perceived in the market today is just still too high. That means that if there is a goal that is, that all the African governments, for example, and international institutions decides to electrify 300 million people over the next 5 years, there is a lot of risk to be absorbed if you want the private sector to take his part. So it means that basically you have some instruments that are guaranteeing the return, even if it's not huge return. We are talking about 15 to 20% range for private investor to invest in that type of asset if someone is actually taking the risks at the beginning at least. But the problem is that we don't have the scale yet to be able to have, I think that we will see some new steps during the next 2 or 3 years where you'll have a second wave of assets deployed that will start really to create a massive trend toward the scale that we need to reach, which is thousands of mini-grids that needs to be deployed in 5 years. So we still need to build up on the data to be able to showcase the real risks that are manageable, and so that institutions like yours can actually adjust their instruments progressively to make this market bankable and mature enough for the private sector to fully take its role in that game.
Thank you very much. I'll move over to you, Derek, as we finish the questions. I think you have managed to raise quite some amount of money, and you're working on like a large platform. But how can we scale this? And I know predominantly you work in Nigeria, but are trying to cut across the West African region? How scalable are these solutions? And how can we ensure that they are replicated across the region? Because we see a few ripe markets. Nigeria, Uganda, we can name them, 3 or 4. But how can we replicate these across other regions that are still very low in terms of energy access?
Yeah, this is a good question. I think when it comes to scaling up, there are, from my own perspective, two major drawbacks. We can't, and when I say we, I'm talking about equity providers and developers can't do this or execute this in isolation. There has to be a value chain development. One of the learnings from our previous experience is you get slowed down because you do not have in country the right value chain to support these businesses or these projects going on. So you see the projects are kind of wavy in terms of operations, things shut down, wait for intervention, which takes time, and that of course obstructs the return profile. I also think that being able to scale regionally and to a large extent even in country, there's no one size fits all, and we have to realize that executing on DRE projects requires a high level of localization in terms of the offering, and this is why we kind of, one of the reasons that informed us creating this platform is to be able to give that localized touch in managing the businesses. So what could apply in Nigeria, and this is less technical but more operational and commercial. What could work in Nigeria would not necessarily work in Ghana or in Benin or in, and even within Nigeria, what would work in the southwest would not necessarily work in the southeast. So I think that recognition of these two factors and in execution or building up businesses or projects or platforms that have this type of projects, one very key important factor is having an understanding of the supporting infrastructure or value chain infrastructure that would support that life cycle of that business. And then secondly, really understanding the local nuance of operating and executing those projects in those locations. If not, you're going to get slowed down.
Thank you. Over to you, Ieva. How scalable are these solutions? I know your facility, once it comes up and it works, how do we roll it out? How do we make it scalable and replicate these? I'm sure you said that it's specific to specific countries. What will take it to the other geographies?
So the facility we're currently working on is called a pilot facility, and it's quite small scale. The reality is that demand from the developer side is very sizable. It's quite unquestionable. But the demand from the buyer side still needs to be proven. So that's what we'll be working on. Our plan has always been to scale that pretty shortly. I mean, once we start, demonstrating results, and in a couple of years, I mean, the facility's lifetime will be much longer, but in terms of working on a scale-up strategy, we plan to do that quite early on. At the moment, the way we're thinking about it is that probably the scale-up facility should include other kinds of what we call impact RECs. So a high-impact REC facility, you may have heard of DRECs, so RECs from distributed renewables. HRECs stand for health RECs, or health electrification. There's a sort of plethora of those. We think that Camco and EPP are most advanced in this work to date, and that we're quite well placed to work with other stakeholders in this ecosystem, and to do a proper market assessment and to see how we could actually integrate potentially all of these to then be able to reach the geographic scale, as well as to allow us to offer a broader offering to the corporate buyers as well. So that's the plan, and as I say, we'll once PAF becomes operational, we'll start this market development work quite early on.
Thank you very much to the panelists. I will open up the session for questions, and I'll stand up because there's a group here I cannot see. So feel free to ask the questions directly to a particular panelist. We have a few minutes for questions. Again, it's lunchtime already. We'll take like 2 or 3. Thank you very much. We can take another question.
Hi, Matt from One Power. This is about the lack of deployment of committed capital in the sector, at least when we're talking about mini grids. A recent figure suggests about 15% of committed capital is actually deployed. Most of these instruments are debt and RBF, and the debt and the RBF are both risk-shielded instruments. And so we've heard a lot from the panel about risk and the lack of alignment between risk and reward in the sector. What is the utility of concessional instruments if it's about better debt terms or longer tenor, or it's about an RBF? The RBF doesn't concern itself with how the CapEx is acquired, how the asset is built. The debt doesn't concern itself with where the equity comes from. It presupposes it. If the real answer here is that the equity, the risk-taking part doesn't exist, I don't see how more concessional debt or more RBF is going to change that equation. If the real challenge here is that we need risk capital, we need first loss facilities in the capital stack, at what point do we rethink where the concessional funding goes? Because an 85% deployment of committed funding, 85% deficit in the deployment of committed funding is clearly indicative of an underlying structural flaw in the theory. And do we have an alternative to that theory? I do agree that the local pension funds, and we're doing this in Lesotho, do have a role to play here, but as Idris says, 3 to 5 years down the line, then it's a low risk, low return asset as opposed to a perceived high risk, low return asset. But we need something to bridge to that 3 to 5 years, construction and operational period. That instrument doesn't exist. Can we not transform some of the concessional debt and RBF into a first loss type of facility?
Thanks, Matt. There was a question here.
I'm jumping on your question. So I am the CFO of Wilayat Africa, and I can understand what Idris went through. My question is the same. What is your expected equity return for concessional equity? Because today, when I'm doing my Excel sheet, computing my WACC, cost of equity in Africa is like more than 20%, and I can't sell that to future investors. Thank you.
Thank you. One last question here.
Good afternoon, everyone. Thank you for the wonderful session. My name is Ajibola from Okra Solar, and we're a leading provider of mesh grid technology. So my question is to Derek, Doris, and Idris as well, which is, I understand you provide project equity into these companies. So do you sort of look out for majority stake in these projects? Like when you're working with these energy developers, is there a particular stake that you're looking out for? So that will be really helpful. And I guess the second question is about returns as well. So if you could have an idea about what your expected IRR is for this DRE projects, that will be helpful. Thank you.
Thank you very much for your questions. We will try and answer some of those. I think we can start with Idris and Derek, how your returns look like, and then we'll go to Doris and what return you're looking at in terms of, as an equity investor, what returns are you looking at? So.
this one is dead. Right, so I can answer on what's the target for the equity IRR and then the project IRR that we think is actually doable today, which you will see is quite of an issue. The reality is that the first wave of project is hardly reaching 10% equity IRR, which is too low for investors to really step in the market, I mean, based on the economics of the mini grids yesterday. I think that the new generation of mini grids, what we are seeing now as a reasonable project IRR, is around 12 to 15%. So once we have said that, if your commercial money has a target that is higher than that, then it's your job as platform or fund manager to blend and to reduce your cost of capital. Because the reality of the mini grid is that it cannot deliver 20%. I mean, otherwise, who will pay for this 20%? It's your customers, and they are not able to pay something that will lead you to 20%. On the concessional funding or cost of capital, I cannot answer because I have private investors, so today it's hard for me to answer on that. And to the last question on the participation, the way we are deploying, because we are an asset management platform, the profile of our historic investor is that we take majority stakes in the asset co we are financing, but we have obviously flexibility. The reason why is because in terms of governance and long-term commitment to be able actually to follow the assets during their whole lifetime, it's easier for us to be with the majority. I will let Derek answer on this side.
Thank you. Yeah, I'm just going to add, I fully agree with what Idris has stated, but I'm going to add that on the return side, I think where we talk about concessional capital or junior capital, it's largely how that capital is applied. If it's applied in a manner that incentivizes participation of commercial capital, in a manner that considers the long-term sustainable nature of the project, then yes, you would be able to get very good, decent returns, and you can balance that out with the impact or development outcomes that you're seeking to achieve. Now, I think earlier on I used an example of different types of investors seeking different types of, some seeking returns, some seeking connections, and I'm talking about concessional investors. If you anchored, at least the way we think about it, is that if you anchored wholly on one category within the DRE asset class, then you would get the returns there. But you have to also not just blend the capital, but blend the asset class in such a manner that you're able to optimize returns and at the same time optimize development outcome. In terms of control versus minority stake, because it's within platform, control is usually the route to go. And I think another factor that drives whether it's control or minority is how much cash skin in the game is the project developer or sponsor bringing to the table. Most often than not, at least what we've seen, is that source of capital is thin. And so we have to step in, basically, or step in a more form than we would have initially wanted to. And as a result, we would like to have control over the business. Now, there's always a way to design a path to reverse that control over time. But I think at the early stages, call it 5 years, it's not in your patient's spectrum, but over the 5-year period, you're able to then reverse that control back to the sponsors. Thank you.
Doris, in terms of, as an equity investor, what kind of returns are you looking at? And you can also maybe mention what kind of control do you require?
Yes, so in terms of returns, because of the capital we have a bit more flexibility. We don't have a fixed hurdle rate that we need to achieve with the projects. So we tend to really drive that from the overall risk of the project in terms of the market, how stable it is, investors. And yeah, the business model, of course, the type of sponsorship. So ours is not fixed, and we are allowed to take lower than what other commercially oriented equity investors would be able to do. In terms of stake, our preference is a strong minority between 20 to 40%. But because we come in very early, sometimes we do end up maybe with the convertibles so that the sponsors are still able to maintain the ownership, or we might take on a higher ownership stake as Derek, but with a path to reducing that maybe at financial close so that we then go back to our strong minority preference. Thank you.
Thank you very much. I think time is way gone. I see Ines is looking at me. But Matt, I generally agree with you. It's unfortunate that the RBF programs that we have are really difficult to unlock. And I think Joa has laughed, but yesterday we said that you have to get bridge capital to unlock the RBF, which is really not how it's supposed to be. I think the RBF really and the concessional funding we have around is supposed to be the first loss funding for the DRE space. So I totally agree with that. Yes. So thank you very much, ladies and gentlemen. And it's now lunchtime. We really appreciate your audience and your indulgence. And feel free to approach the panelists after this and ask them specific questions if you have. Take their contacts. Most of them could maybe introduce you to other investors in the room. Thank you very much.
Hi everyone, thank you for your patience with the delays. So we'll be heading to lunch break now at Sunset Restaurant, and we will be back at 3 o'clock. You can collect a lunch voucher in the hallway where the registrations were taking place as well. Thank you.